In terms of the consequences of our accounting choices, so we've made an inaccurate forecast. That's going to affect our earnings performance. That's going to affect our stock price. That's going to affect our volume, which means how much of our stock gets traded. Our liquidity, again, which has to do with how much of the stock gets traded. In the United States, if you make a mistake on your earnings forecast, you can be sued. If you're a manager and you make a mistake on your earnings forecast and you get sued, that affects your reputation. That may affect your compensation. And then we know in the United States that CEOs have a shelf life about 5 years. So from the time you begin as a CEO to the time you are retired or fired as a CEO tends to be about 5 years. And if you make a mistake like this, that 5 years will be on the short side rather than on the long side. Now let's look at the reaction of DreamWorks stock to these lower than expected earnings. Remember that we announced our earnings on May 10th. The stock price fell about 14% that day. There was a huge spike in volume that day. And again, when the market learns of our earnings shortfall, minus 14% return, roughly 10% of our shares outstanding were traded. That's 5 times the normal share volume. And most uncomfortably, we lost $450 million in market capitalization. Market capitalization means if you take the share price and multiply it by shares outstanding, that's also known as market value or market cap. And then finally, we got sued by 6 different shareholder groups. And getting sued is really bad if you're a chief executive, because even if you're innocent, it takes lots and lots of your time going to court, being deposed, sort of sitting around. And all that time when you're sort of dealing with these lawsuits, it's time that you're not running your business. So in terms of the takeaways from this mini case, Shrek 2 for DreamWorks, we see the market considers earnings information to be important. We see this trade-off between relevance, we want to get shareholders information soon, versus reliability. If we wait longer, we can get them better information, but it's not as soon. We see there's 2 types of accounting. Cash flows, which is when the cash comes in, that's reliable but not relevant. Then there's earnings, which are a combination of cash flows and accruals. And accruals are estimates of future cash flows. So earnings are relevant but less reliable. So there are accounting rules and there's accounting judgment. The rules say that we can record revenue when we ship these DVDs. Judgment is what management uses to figure out how many of these DVDs will be returned. This rookie management team in this early stage company used bad judgment. They made a mistake here and they're paying for it with stockholders' lawsuits.